built my portfolio, the more confident I became in myself. My Samsung camera simplified everything. If I could inspire just one person, that would be awesome.
Work screen tells me 200,000 jobs in the month of February. That's not bad. That's not a slowdown. So it really does boil down to that we are simply not slowing down. Where is the slowdown that we all had expected for so long, including myself and the consensus and the Fed? Remember the Fed last year said we expect a recession in the forecast, and they have taken that out. So I think if we were wrong and waiting for Godot for so long, maybe Godot will not arrive in the next quarter or two either.
Torsten, really thoughtful piece. Always enjoy catching up with you, sir. Thank you. Torsten Slok there of Apollo on why this Federal Reserve won't cut rates in 2024. Coming up in the next hour, we'll continue this conversation. We'll catch up with Daryl Krumpiter of Morgan Stanley and a whole lot more from New York City. This side risk, that is not typically the kind of thing you'd expect Nouri Arabini to tell you.
He didn't add to my list of worries. If anything, my only worry now is that there is no pessimism anywhere, that it seems like everybody just feels like the upside is the only case that can exist. The fact that even if we have his worst case scenario of upside risk to growth, the downside for stocks would be a mild correction, nothing that insignificant. I mean, this is from the Uber bear of Wall Street.
And then we get Chairman Powell for his assessment a little bit later. I wouldn't call him the Uber bear of Wall Street, but the outlook for him, Bloomberg's Anna Wong, Powell will signal he's in no hurry. Mike Gapin over at Bank of America, Powell needs greater confidence. Citi's Andrew Hollenhorst, the Fed needs more data. What kind of Chairman Powell is coming up on Capitol Hill this week?
Well, if you believe what Torsten Slok is saying about no rate cuts, he is going to face some serious pressure from Democratic lawmakers like Elizabeth Warren, who said in January he already should be cutting because they were so concerned about what this means for lower-end consumers and what it means for people that are dealing with higher housing costs and higher rents. So he's going to get a ton of pushback from Democratic lawmakers if he's saying that, well, we're waiting for the data. And they're saying, well, the data is already showing that you should be cutting.
Well, he can point to the labour market. 200K is the estimate for Friday. 200K, the previous number 353. Unemployment at 3.7%.
If anyone looks at those data points and say you need to cut right now, then they're looking at a different set of dashboard indicators than a lot of people are in this market. There is a real question, and Torsten Slok was alluding to this just in terms of who these rates hurt the most, how the sort of compositional aspects of keeping rates higher for longer really do shape, maybe not things when it comes to the magnificent 6 or 5 or 4 or whatever you want to say, but when it comes to the political sphere and just how people are really messaging.
Yeah, let's be blunt. If you're a saver, great times.
Right.
If you're a borrower, not so great.
And well, basically, that's what we've seen with, some of the auto loans absolutely tanking because people can't afford to spend 8, 9, 10% on a vehicle that also is much higher than it has been in the past.
Credit card delinquencies as well, something we talked about in this programme over the last few weeks. Let's set the stage for you. Equity markets on the S&P 500 pulling back by 0.2%, just a touch lower here. Bond markets, yields higher by almost 3 basis points now, 420.91 on a 10-year. Coming up this hour, Daryl Kronk of Wells Fargo on why he thinks the market view is too rosy. Ed Mills of Raymond James previewing Super Tuesday. And Morgan Stanley's Seth Carpenter weighing in on the Fed's road ahead. We begin this hour with our top story. Stocks setting a record high on Friday ahead of a monster week on Wall Street, including the jobs report and a double dose from Chairman Powell. But Daryl Kronk of Wells Fargo thinks investors need to take a step back, saying this: the S&P remains near a recent record high, even with the probability of Fed rate cuts this year falling from 5 to 6 down to the current expected 3 over the last 2 months. Lighten up on the top 12 outperformers, including tech. The market view is too rosy. Daryl joins us now for more. Daryl, let's get into that. Lighten up where? We're talking about the Nvidias of this world, the top performers of the last 12 months?
Yeah, I think you can certainly lighten up your equity exposure overall. I mean, I would take it first from small cap, which has been, a relative underperformer, battered and bruised. But I think you do have to lighten up. If you've enjoyed 24% return over the last 4 months, which is what you've gotten, November, December, January, February, 4 months, right? That is impressive. You'd be wise to take a little profit there. To the conversation you were having earlier, remember and recall sage words, wisdom says bull markets die in euphoria, right? To the point, there is no downside that anybody sees at this point. We are starting to approach a little bit of euphoria here, and I think you have to set that context correctly.
Let's get into that word, euphoria. So Savita Subramaniam's come out over at Bank of America. She's gone to 5,400 from 5K. She says any signs of euphoria are thematic and secular. So we're talking about AI, Nvidia, we're talking about GLP-1s, we're talking about Novo Nordisk. Outside of that, where are you seeing what you would describe as euphoria?
I think you're seeing it in, well, you're definitely seeing it in technology, you're definitely seeing it in consumer discretionary, you're definitely seeing it in comm services, all the leaders that have continued to lead. For markets to really make that next leg higher, you've got to have three things happen, right? You've got to have breadth widen out, right? Narrow markets die painful deaths, right? I mean, 2023 was the narrowest market only to 2007. We know what happened in 2008, right? And if you go back and look at other narrow markets, 2020, 1999, 2021. Remember 2021 to 2022, what happened in 22? Big negative returns. What happened in 1999, in 2000, right? So narrow markets don't sustain that leadership. History teaches you that lesson over and over again. So you need breadth to widen out, you need earnings to participate, better fourth quarter numbers, right? We'll take the earnings growth, but think about it this way. If companies, even large cap companies, if their wages are still growing 4, 5, 6%, right? But their top line, we just saw the total sales number grow at 3, let's call it. I can't have my biggest expense line as a company CEO or CFO growing at 4 or 5% and my top line growing at 3 without starting to lay people off, without starting to roll the economy over in that sense.
So you can't talk about 2007 and sort of some of these others in 1999 without really giving some sort of size and scope of what you're expecting. Is lightening up simply because you see a rotation in leadership or because you see some serious downside ahead?
I think you could, so let me put it this way. If you take forward multiples today at 22 times, right, you're in the 90 to 95th percentile of the last 30 years of historical multiples and valuations, right? When you spin the clock forward, when you get into above 90 percentile, you spin the clock forward 12 months, your average annual return is 0%, right? So I think you can probably crest here as earnings catch up, which is often what happens. You pull prices forward, prices reset, and then earnings have to catch up. But let's be clear, they have to catch up, right? I mean, the consensus is still at 243 for earnings estimates today. We'll finish the year probably for 2023, we got 97% of earnings in at maybe let's call it 220, 222, 223, somewhere in there. That's a big jump for this next year. It has to deliver, right? The micro has to deliver. It's no longer about the macro.
How much are you really counting on the Fed to cut rates by 3 or 4 times this year to really keep things on an even keel, if not necessarily going gangbusters, at least not declining materially?
I tend to agree with where the consensus is starting to go to. I think the Fed's going to have a hard time cutting rates the amount of times they want to. What people forget, think about this. So we know we've had goods-based disinflation, right? The goods sector has come down hard. Services, which is 70% of this U.S. economy, you know what the inflation rate is of the services piece of the economy today? 5%, right? Is 5% anywhere close to where the Fed wants it to be? That is way too high and too hot. You couple that with the wage inflation we just talked about, right? And you couple that with also probably losing the tailwind of goods deflation. I think inflation does stay higher. And look, if you look at the bond market, so I went back and looked over the weekend, and I was trying to show me a period of time where the 10-year Treasury was increasing. Remember, it went up 34 basis points in the month of February. The 10-year Treasury was increasing 3 months before the Fed cut interest rates, and I couldn't find one, right? So rates are still climbing, inching higher, when if the Fed's going to deliver on this May-June timeframe, they should be about facing it coming back down.
Do you then agree with Torsten Slok of Apollo that there's a real chance that the Fed is not going to cut rates this year at all, and that markets can still stay pretty much on an even keel?
I think the Fed desperately wants to cut rates. I don't know whether the data is going to allow them to as many times. I think we're going to have to look at our own estimates, right? But if we don't get to your very question, if we don't get rate cuts, yes, then I think markets have to reprice from here, because I think the consensus is still too strong that rate cuts cometh, right? And without that tailwind, I think you're going to have a hard time with equities being at the valuations that
Can we just get to the lesson of the last 2 months, though? Because we have gone from 6 to 7 all the way back down to 3, and we've done that painlessly.
Painlessly.
How have we done that?
I think what you're doing is you're papering over what the great lesson I think that we've learned here over the last couple of years is the amount of fiscal stimulus, right? When you look at it's 9% of the GDP, right, is the budget deficit we're running, has just papered over and papered through a lot of what's happening, right? I do think you are going to start seeing markets pay attention if you come down below 3 rate cuts. So if some of the narrative that you're getting today, John, continues in that direction, i.e., 1 or 2 rate cuts or 0 rate cuts, I think markets will start to pay attention to
I think this is a challenge for me because, Lisa, we repriced from 4.1 to 4.7 on a 2-year. We priced out 6 to 7 cuts and we're pricing in, say, 3 right now. And this equity market carried on rallying. And we'd had this same conversation at the start of the year. Without a doubt, overwhelming consensus would have been we cannot do that without this equity market selling off, and it didn't.
Well, and part of the reason why is because all of the biggest companies, to Torsten's point, have termed out their debt, have fixed rate debt. They've locked in lower rates. They're not necessarily that sensitive to higher rates anyway. And guess what? They're making their earnings continue to rise on the heels of the strength that is not really allowing the Fed to cut rates as quickly as they'd like.
Darryl, before you go, you're not exactly screaming go to cash. There are sectors you do like on this S&P 500. What do you like right now?
Which is the theme of widening the breadth out, right? So I would phrase it this way. Materials and energy on value, on kind of a deeper value and valuation opportunity. And then we still like industrials and healthcare, which have been really strong relative outperformers of late. So I think you can end with that. And I would just, to Lisa and your conversation, I think the great question we have to ask and reverse engineer is, if 5.5% Fed funds slows nothing, right? It didn't slow business, it didn't slow consumer, right? Hasn't slowed government spending, right? Why cut, right? What's the thesis to cut if 5.5% really doesn't become friction in the economy?
It's exactly what Torsten is asking right now. Darryl, it's good to see you.
You too,
Great to
John.
catch up. Darryl Cronk there of Wells Fargo. Torsten Slok basically said break-even rates, what did he say on the 2-year maturity, starting to climb higher. Equities are at all-time highs. To your point, 10-year Treasury yields are rising. It's an odd time with that in isolation, just looking at that specifically, for a Federal Reserve to be cutting interest rates.
Where's the confidence that they're actually going to get down to 2% in any of the data that you just listed?
Not much right now. They need more confidence. Isn't that actually what they're telling us, though? Because maybe a little space to push back would be Darryl saying, they want to cut interest rates right now. They look pretty hesitant to cut interest rates based on the communication we've had.
Which is the reason why it's now plausible that they will not be able to cut rates at all this year. Because if the data continues at this level, then how can they answer the question that Darryl just asked, with the sense, we have strong conviction that it's the right move.
2 days of Powell testimony on Capitol Hill coming up a little bit later on this week. Let's see how much confidence and conviction he has. Equity futures right now on the S&P negative by 0.1. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Boeing has confirmed it's in talk to make Spirit Aerosystems part of the company again. The part suppliers at the center of the issues impacting Boeing's 737 MAX jet. Boeing said in a statement, quote, "We believe the reintegration of Boeing and Spirit Aerosystems manufacturing operations would further strengthen aviation safety, improve quality, and serve the interests of our customers, employees, and shareholders." Amazon's Whole Food grocery chain is planning a new small format stores for Big City aimed at serving quick trip urban customers. The stores will be between 7,000 and 14,000 square feet. They won't have a buffet bar or meat counters. The grocer has signed 5 leases in New York City for the concept. The first Whole Foods Market Daily shop is slated to open on the Upper East Side by the fall. Dune 2 has taken the top spot at the weekend box office. It netted ticket sales of $81.5 million in the U.S. and Canada. That's the biggest opening of the year so far, and the largest since last year's Taylor Swift film. The sci-fi sequel blew past conservative estimates, and some fans packed theaters for 3 a.m. IMAX screenings. That's your Bloomberg Brief. John.
Danny, thank you. I watched Dune 1. I think I left 15 minutes before the end. I have no idea what happened in the movie. Still to this day, do not understand it. And I will go and watch Dune 2, Bramo, just to make that happen.
Wait,
and we'll see if
seriously?
I can catch on. Just see if I can catch up.
Okay, that means that you enjoyed it, secretly. You walked out before you're going back for more?
It. Big, like, worms underneath the desert.
I haven't seen it, so I can't wait.
Finish the end of Dune 1
I mean,
before you go
seriously.
see Dune
And
2.
Chalamet doesn't strike me as like a hero-type character.
What do you
know
think
what I mean?
he strikes you
I mean,
as?
should it be like, some high school dude at Mean Girls or something like that?
Well, he wasn't Wonka,
Yeah, maybe.
Did you see
Maybe.
Wonka?
I haven't watched that yet.
Okay.
I will.
Is that
Not the
next
kind of thing I'd go to the movies for. Up next on this program, a critical week on Capitol Hill.
I do believe that President Biden is getting that sense of urgency. I think we are seeing a campaign that post Super Tuesday is going to go all in on the ground and knows what we got to do to get the job done.
That conversation coming up next, live from New York. This is Bloomberg.
world needs waves.